Our perception of money is changing rapidly, and banks are at the center of all of it. From how we access it, to how we buy, to how we trust that that money will be there when we need it. I'm Kiah Haslett, the creator of FinTech Takes Banking. Here on Bank Nerd Corner, I talk with bankers, economists, academics, and more about the complex dynamics shaping the financial services landscape. In this month's Bank Nerd Corner Squared, Alex and I talk about how everything old is new again, namely updates and developments to topics we've chatted about in the past. We start by discussing potential merch ideas. Please let us know if there's any FinTech Takes or FinTech Takes banking merchandise you'd like to see. We then move on to a chat about the newest bank, or dare I say social club, in the country, the skinny master account proposal, the difference between fair value and reserve accounting, and a rant about one specific industrial bank. Hey, Alex, thanks for joining me.
Thank you again for having me back. Bank Nerd Corner Squared. It feels a little strange because we just saw each other in person, but now we're back to our normal
2 weeks in a
routine.
row.
I know. It's a lot of in-person time. Are you sick of me?
Not yet, but it's weird when I see you in person because I'm so used to talking to you virtually. Do you ever have like a friendship where you just like talk to each other all the time virtually, and then when you hang out, you're just like, so how's the family?
Yeah, it's weird, right? Because like it's a good point. We talk so frequently via text and through podcast recordings and whatever that when we see each other in person, I think like we try to pick some topic that we don't talk about constantly.
Right.
And so it does end up being like soccer, family, travel, like things that we don't go back and forth on. But lovely to see you. I am not in any way sick of you. If you had asked me that question,
I would never ask you that question.
I wouldn't have paused before you answered. I heard you pause, which I'm not going to take personally. I'm just going to like
I was trying to think of a
happen.
funny answer, and I couldn't. I was just like, yeah, I mean, it is weird to hang out with you in person.
It is.
And then also, I have to offer you my annual Lunar New Year. Happy Lunar New Year.
Thank you.
It's next weekend, or
Okay.
It's like it's like next Tuesday.
I'm excited
and it's
about
Year of the
this.
Horse. So
Year of the Horse. Okay, so I am very excited about this. I actually take Lunar New Year's very seriously. We always have in my family. I'm not sure why exactly. My mom is a big fan of it. And so we study these things closely. We have multiple horses in my family.
Wow.
And so, yeah. So my brother is a horse. So should be a good year for us. How was this last Lunar New Year's for you? Did you get what you wanted? Yeah.
Of steak. I think there's room for improvement every time. I have some notes, but I mostly just like to get together with my friends and wear red and eat Asian food and be like, it's my culture. So
get to indulge the culture.
Yeah. And I'm going to be in New York for Lunar New Year.
Right.
And I have high expectations for a city with a large Asian population.
You'll have to send, I'm sure you will send photos, videos. Like I want to see what it looks like and live vicariously through you. I'm very excited for that. You also are getting a tour of a place that we can't disclose, right?
Yes.
Like I can't even say what it is.
I'm taking the newsletter on a field trip, and I'm really excited to share in a couple of weeks where me and the newsletter go and bring some observations to the readers who weren't able to accompany me.
Well, that's very exciting. Wonderful tease for the newsletter. Kiah, can I tease one more thing that I wanted to share with listeners, which is Kiah and I are deeply engaged in the process of figuring out what merch should exist for FinTech Takes, which I'm very excited about. Kiah, I know you have lots of strong thoughts on merch. I think I have probably had more like hands-on experience with different FinTech merch over the last 20 years than almost anyone. Like I've experienced the good, I've experienced the bad, I've experienced the weird. And so I have lots of opinions on merch. What is your like number one, I want to manifest this as FinTech Takes banking merch? What's number one on the dream board?
I'm realizing that like I'm not a very serious person and I'm not like, this isn't where my creativity comes from. Like I'm not a merchandiser.
Sure.
And so if I could guarantee we wouldn't get sued, I want to do First Republic umbrellas.
That is a good one. That is a very good one. You have kind of
if you have to explain it, then this merch isn't for you. If you don't know what I'm talking about, the merch isn't for you. But if you do know what I'm talking about, wouldn't that be fun merch?
It would hit. Yeah, no, I think so too. I mean, it's cool when things that used to be a status symbol become sort of an inside joke. And I feel like that's a perfect example of that. So I like that. My number one pick is those like mini basketball hoops that you hang up on like the back of a door, like in your office or whatever. I want one of those branded fintech takes because I think
that's good.
Like, yeah, that's like it's good for work for home. It ties to sort of my passion for basketball, which people know.
Yeah.
So to me, that, and I don't even think it would be that like expensive. Right. The other thing you worry about with merch is like, yes, I'd like like a crystal decanter with FinTech Takes logo engraved on it. Well, okay, but like that's not really feasible for most people.
Right.
Whereas I feel like a basketball hoop, like we could get those things out everywhere.
Yeah, I wish you liked sports other than basketball, because I think a little mini line of office like sports ball would be pretty fun. And I just was like, man, if you were into paddleball, you could have a FinTech Takes like paddle.
I'm not opposed.
That'd be good.
To this.
But I couldn't be me. So
well, I mean, let's manifest just like getting all of the different fun FinTech Takes merch ideas out there. Call to listeners. If you'd like to drop us a line in any of the ways that we are reachable with ideas for merch, Kiah, I think in particular, is susceptible to like funny niche joke ideas for merch. I too am interested in that. So hit us up with your best ideas, and you'll start to see more merch coming in the next, I don't know, like 6 months or so.
Yeah, I mean, not to rep the FinTech Takes network, but the network crushed the Valentine's jokes call out, and I had 26 Valentines, and I only wrote one of those. Everything else was crowdsourced, and everyone was amazing. And so I think a lot of those people maybe also have experiences with financial services merchandise and what would be good and cool merch, and then also like very niche to the brand or an inside joke merch. So I would be, I'm going to probably have to hit some of them up for ideas. Or what not to do, too. That's also very valuable information. No,
it is. It is. And, I think we share a passion for making sure the merch is very good and very high quality, because it's one of those topics, actually, when it came up inside of our company, they were like, oh, yeah, we're doing merch, kind of just as like an offhand comment. And Kiah and I think both were like, can we please be involved very deeply in the discussions around this? So even though we are busy and have lots of content to create, merch is something I am willing to carve out time for. Also, if someone can explain how we can make a First Republic umbrella and not get sued by JP Morgan, I would really appreciate that. Like, if someone wants to tell me exactly what legal words I need to say to make that happen, let me know. So call to the lawyers out there. Awesome. Okay. Kiah, it's your show, so I don't mean to grab the steering wheel, but do you want to talk some banking news stories? Yeah, there was a pretty exciting de novo announcement this week, and I think we need to pop some champagne. Yeah, we do. In fact, our guy at the OCC, Jonathan Gould, tweeted about this new bank, the first de novo national bank under Trump administration 2.0. Great. Erebor is now a bank. We've talked about Erebor before, but obviously now that this has happened, a bunch of new information has come out, a lot of new quotes and conversations. There was an article in the Wall Street Journal that had a bunch of quotes in it. Sure, it had a lot of quotes. It had a lot of quotes. It had a lot of like statements that I think you and I had the same sort of general reaction to it, where I was like reading it and I'm like, either I don't understand how banks work or they don't understand how banks work, and I'm not sure which it is. Mm-hmm. A couple of things, and I'd be curious, go for it, Kiah, for you to jump in on this. So Erebor is valued at more than $4 billion after raising its latest round of $350 million from investors. I think, this is so weird because we don't really do this in banks when they're private. Right. Like the bank is not public, so I don't know where this valuation comes from. And you guys, I have told you multiple times, I do not understand fintech valuations and where those numbers come from. Why is that happening here? Oh, it's happening because Peter Thiel and all of the people who pump up the fintech valuations are now piling into Erebor and are getting excited about investing in a bank. And it was funny, actually, that you mentioned that, because in the Wall Street Journal article, they were saying that I think they were referring the earlier valuation from the last raise before that, which was like a $2 billion valuation. And again, these numbers just seem made up to me. I don't know what they're based on.
Completely.
But one of the things that was funny was they were like, yeah, and that was a 7x premium on its book value. And I was like, but it's not a bank yet. Like, it's not doing anything. Like, how can it be? I don't understand that. So, like, the valuation math doesn't make any sense.
The book value is if the bank burned down, what are the pieces worth? And tangible is like excludes goodwill, because goodwill is also a fake accounting entry, or it's like, an intangible asset.
Yeah.
So like, what in this bank
what do they have?
is worth 7 times? Right? That's what that word means. That's what it means.
That's my question. That's my question. When I read that, I was like, because they don't have branches, I don't think. If you go to their website, by the way, there's nothing on their website.
I haven't been to the website. Isn't it Erebor.bank or something?
Yeah. And it just says Erebor. There's no, you can't, it doesn't do anything. And so, like, what is the thing that is 7x valuable? Like, I don't know what that is. And so, like, to me, it seems from the outside as though it's more like 100x valued its book value, 1,000x. Like, it doesn't, like, this valuation doesn't make any sense. Infinity. So I don't understand that. I don't understand any of the commentary that has come out around this. So obviously Palmer Luckey is the sort of organizing force behind Erebor. That's among other reasons why it's named after a fictional mountain from the Lord of the Rings universe. And he's talking about it in a way that just feels very, very strange, right? So, like, in his comments, he's been talking about, this is going to be like a simple bank, and we're going to do simple things like not lose our customers' money and not assume the market will never go down. And, like, these are very, like, thinly veiled shots at Silicon Valley Bank, which Erebor is stepping in and trying to sort of fill that gap, although they're not the only ones who are trying to do that. Mercury, that's also becoming a national bank, apparently, has really been going after that market for a long time. But it's strange because, like, his commentary about this is just going to be like a simple bank that does simple things well. He's actually described it as like, it's basically the tech startup version of like a farmer's bank for farmers. And it's like, that's kind of cute and feels sort of like charmingly old-fashioned. But I think it kind of completely misunderstands banking, right? Because, like, in the case of Silicon Valley Bank, like, two things I think are true about Silicon Valley Bank. They did a terrible job with risk management and managing things like interest rate risk.
Sure.
But arguably, in a more, like, global, broad sense, the flaw of Silicon Valley Bank, which you and I have talked about many times since it failed, is that it was just a very concentrated bank. It served one market in a very concentrated way, and therefore any risks that it took, and again, its risk management was terrible, but any risks that it took were magnified by the fact that they were just working in this one segment without it being expanded beyond that. So you apply those ideas, and you sort of apply them to Erebor, and you're like, okay, are they less concentrated? No. In fact, I would argue they're probably more concentrated. Do they have financial incentives that would require them to take some level of risk? Well, yeah, that goes back to the $4 billion valuation. Like, investors put money into this thing, and I presume that they would like to get a return on their investment. Banks return investors money through taking risks primarily. Like, that's how they make money. And Palmer Luckey has said their goal is to never have more than half of their deposits loaned out. Like, they want their loan to deposit ratio to be 50% or lower. That is significantly lower than your average commercial bank. Like,
also, SVB had a really low loan to deposit ratio too. They also, but like SVB had just taken a lot of those deposits and put them into securities, which is where the interest rate risk comes from.
Right.
And so it's like,
it was
so are you like not
safe.
going to do that second part? But like, how are you going to make, I'm just so confused. How are they going to make money?
That's my question. That is like my go-to question is like, how, like, okay, you're not going to loan out money, but they are going to, because when they talk about it, and there's a quote in here, it said in its investor pitch last year that it plans to offer lines of credit backed by crypto or private securities famously safe things that never have any problems, and loans for advanced artificial intelligence chips. Again, a thing that is definitely not like overhyped or in a bubble, that very safe to lend against. Erebor says that its understanding of its customers' businesses will let it more accurately gauge their risks and offer more attractive loan terms. Erebor plans to sell many of its loans that it makes to other banks and investment firms, an approach that likely means it will have to stick to loans that aren't too exotic. Kiah, those two things don't fit together. Those sentences don't make sense in the same story.
Not exotic loans. I too think of crypto back lines of credit and
artificial
AI
intelligence chips. Yeah,
loans.
That's what I'm saying. I
and
was
that
shocked.
Very attractive terms. That's what I like. Is term this market, this very niche. One thing that we know about banks is when they serve a niche market, they can charge lower prices.
Yes.
Right?
Exactly.
Why?
So,
why are we doing this?
That feels totally fair. I also thought your observation about Palmer Luckey is not even in an operational role. He's not the CEO of the company.
That's correct. I don't know who the CEO of the bank is.
That's right. Where are the people who are in charge of the bank who are going to be actually running it? What do they think? How are they speaking about this? I will mention on that note that Joshua Rosenberg, a longtime employee of the Federal Reserve Bank of New York, who came on as chief risk officer at Erebor in May of 2025, left in January of this year after only 9 months at the bank. That doesn't make me feel amazing about what the plans are or what's happening. And so, I just I look at this new bank that we have, and they are not in any way, shape, or form talking like they understand how banks work, or that they are going to be subject to the same laws of gravity that any company that raises a ton of money from investors will be subject to.
Yeah, I think that's right. Every comment about SVB just makes me wonder, did you have the different conclusion about SVB than I did?
Sure.
Are you gonna is Erebor just gonna have reciprocal deposits, which is one of the smallest things I think SVB could have done, and then
it's insane that their deposits were so uninsured relative to what they could have done. Come on.
I don't really care about ROE and ROI. That's kind of I don't do that with my money. I don't put them into banks to make a return. Sure. But I am I keep kind of thinking in my head Erebor just should have opened a credit union. If you are so if you're so not interested in making money, totally. and your demographic is so niche, just open a credit union.
Well, that's the thing.
This.
That is such a great point, right? Because that is exactly how he's talking about it, right?
It is, right?
That is exactly
that's what I hear when he talks.
That is exactly right. No, Palmer Luckey talks about it, and he's this is just a thing for me and my friends. It's a thing I want to do for this community. He literally said, this is a bank for real Americans doing real things.
Oh, yeah. I've heard, which is not for me, not a real American, right?
Apparently not. Apparently none of us are. But if you have a high enough net worth, or you work in these 3 industries that he cares about, which by the way are extraordinarily well taken care of and well banked, then this is a bank for you. What you are describing and his utter disinterest in lending out money, taking risks, investing in securities, his disinterest in any way, shape, or form in this thing making money, that's a credit union, bro. And it is interesting because you and I talked before about now we have new de novo credit unions that are starting. And in some cases we have fintech companies that are helping to sponsor the creation of these credit unions. So it's not that path is closed. I wonder if it was as simple as he has friends at the OCC and doesn't have friends at the NCUA. Is that the explanation? Does he not know what credit unions are? I'm so curious about that, because I just don't, at the end of the day, I don't see how what the things are that he's saying can be true, and the investors that are valuing this company at $4 billion are going to make their money back. Both of those things can't be true.
I just, I also have, every time I read something about Erebor, and kind of a certain subset of tech, anything, I'm I just don't think I know how the world works. And when I read the Erebor quotes, and we just keep talking about how crazy all the quotes were, and then you see on Twitter everyone kind of congratulating them and saying what this bank will do and whatnot. everything that I have read kind of contradicts everything I kind of know about banks. And so it's like, okay, well, maybe there's some reconciliation I need to do there. But everything I've also, read or everything they say should discount or should lower expectations about how this bank is going to perform. And so it's almost like Erebor is like becoming a Rorschach test for me. And I also, or it says something about what tech people believe banks do and are. And we kind of see this. You and I talk about this a lot with crypto, or how Brian Armstrong is like, oh my God, can you believe banks do fractional reserve lending? That should be illegal. And then you hear that and you're like, wait a second. You think fractional reserve lending is bad?
Yeah, you think it's a conspiracy against consumers. Yeah.
And you think it's like a crazy risk, which I'm not saying it's not, but I'm just saying that's just like the core central tenet of banking. And so I constantly feel like I'm losing my mind a little bit. And the other thing too is like, separate and apart from what Erebor says it's going to do, it's been a while since we've seen de novo banks. And one reason why we don't really see that many de novo banks is like, one, for a while the FDIC didn't want to issue a lot of charters, but it's because in the financial crisis, leading up to the years of the financial crisis, de novo banks that had opened between like 2003 and 2005 ended up taking on significantly more risk, because when you open a new bank, you basically like have no assets and a bunch of expenses. And so you take on all this risk because a lot of the good loans and a lot of the good customers are already banked. And so you end up competing.
You have to like claw your way into the market.
Yes. Right? And you end up competing. And like one way to like make a bunch of loans really fast is like to make a bunch of home loans, right? Because housing has never gone down. And so these banks like basically extended on construction loans that were riskier than maybe previously thought, or had more assumptions. And like, we just kind of can't get away from that. Erebor is in the same situation, and it's kind of worse because they have such high capital. And so it's like when you're serving like a segment of the industry that isn't well banked, in part because it's new and it's hard to value. And like, did I just read yesterday that a crypto-backed loan securitization, was self-liquidating in order to make payments? Like, yes, I did.
Because the price of crypto went down,
Right, because crypto as an asset is so, like, the valuation. And the whole time, I'm just like, where did I not learn the correct thing that would help me understand? And then, like, I feel kind of bad for the Wall Street Journal reporters who just kind of have to, like, take these notes down with a straight face and be like, that's a good quote. No, yeah, that's
it
great
made me
quote.
wonder if they know how banking works, because I was
Do
reading
you
this
have
article.
no follow-up questions? Like, what?
Well, right. I mean, like, they wrote this article and like there were literally sentences back to back that don't fit together, and it was like, do you not see that those two statements don't work together?
Like, you better be working on a follow-up where you explain the questions the reporter who should have specialty knowledge, like, asked and tried to get this reconciliation. Because I just, please don't do this. Like, I mean, like, Judge Judy has this phrase, like, don't piss on my leg and call it rain. Like, that's what's happening right now, right?
That's the only conclusion that I can come to. I mean, it's funny, right? You think about it from the OCC's perspective. Because, I mean, to be totally candid, like, the OCC is taking a hell of a risk here. They really are, right? I mean, like, the chief risk officer left after 9 months. You gave conditional approval for this charter faster than you've ever done before. The delay between the conditional approval and this approval was like nothing. I mean, like, they're publicly praising this company and saying this is how we're going to revitalize the banking industry. I mean, they have staked a large part of their credibility on this working.
Yeah.
And ironically, like, the best case scenario for the OCC, I think, is that what Palmer Luckey is saying is true, and Peter Thiel and all the other people who put money into this just end up writing off this investment. Like, this is like the best case scenario is this is just a really unprofitable bank that just exists based on the goodwill of Palmer Luckey's friends. Like, that is the best case scenario for how this works itself out for the OCC. But again, like as you were saying with the de novo charters, like there's a reason regulators historically have been nervous about these. You know, if a bank comes in and has expectations that it has to meet for its investors, like it has to grow aggressively. Aggressive growth in banking tends to equal taking on more risks. Like there's a reason why de novos have this period where they have to operate without changing their business plan. Kiah, I don't know what this company's business plan is. Like I truly do not know what their business plan is, how they're going to make money. Are they going to issue stable coins? Apparently they made a big deal about being open on Sunday when they opened, again, even though their website doesn't work. Like,
yeah,
it's not a bank. I look at it and I don't understand it.
I hope our friend Jason Mikula signs up for a bank account. You know how he like signs up for
you know
accounts
that he will. You know that like, yeah, that's already happening. I mean, I've joked before that like we need a early warning-esque service that just keeps the Jason Mikulas of the world from opening accounts to like spy on what you're doing and figure this out. Because I mean, like, it's fascinating. How would you even apply for an account? The website doesn't let you do it. I don't understand. The last question I'll ask you about this, and then I will let it go, I promise, is if you were like the CFO at a technology company, and you were just, in a perfectly rational sense, trying to figure out, like, hey, where should we keep our money? Where should we bank? Why would you pick Erebor over, like, JP Morgan Chase, let's say? Like, truly, I'm genuinely asking, like, why would you do that? What would make you do that, based on what we know?
Yeah, maybe you believe in your future. You're going to issue crypto-backed loans or like your stablecoin backed loans, and you need someone who's going to give you attractive pricing on that because they understand the risk your company is taking.
Sure.
I literally nothing that I've read about Erebor indicates that they will be better at serving this, you know, desperately underserved segment of the economy.
This poor segment of the economy,
I just want a ski chalet if I'm a tech CFO.
Sure, yeah.
So I will go anywhere that is offering me use of the ski chalet. So if Erebor has got one, okay, we're there. That's what I'll be sold on.
Well, I mean, that's probably the one thing they can bring to the table that we know is they probably do have great places for tech CEOs to vacation.
Would you bank at Erebor in this situation?
Yeah, I mean, if they would have me, I probably would. I mean, I don't know. I mean,
what if it's like a social club?
It does feel like that. That's exactly, okay, I'm glad you said that, because that is, when you go to their website, and I can't wait, you'll have to text the group chat when you go to their website.
I am on their website
When you go to their
now.
website, that's exactly what it feels like. It feels like when you walk by a social club and there's no sign, there's just these dark curtains. It maybe has the name of the club stenciled in like little letters somewhere, and it's totally subtle, and like if you know, you know, and if you don't, you don't. That is exactly what the website feels like.
Okay, so I just want to flag for anyone who works at the FDIC and listens to this. I don't know if I think the FDIC marketing would meet what we think are the standards.
Oh no.
You have to click on login, and then it's at the top left, FDIC insured. And then I'm trying to say I forgot my password, but it says I need a pass key. So I don't.
Really?
You know, I think maybe this is by invitation only banking.
That seems to be exactly what it is. It's like hard to find and invitation only, and you have to have a pass key. I mean, I guess it works for the very ultra elite segment that it's claiming to serve, but again, like that just doesn't square with, oh yeah, we're just like a farmer's bank for tech. Like it's very simple. It's very,
this is
just
crazy.
Like, don't even worry about it.
I can't believe there's so much
really
hype about this. This is insane. I'm totally insulted.
Well,
I think everyone who is hyping this up on Twitter is stupid.
Yeah, at a baseline level, I think that's a very fair critique.
That's a pretty safe thing to say.
Should we stop giving it attention and give something else attention instead? All right.
Yeah, going towards other things regulators are doing.
Sure. That
people have some thoughts on.
We definitely do.
The comment period for the Fed Skinny Master account is due this Friday. And we spoke about this when Governor Waller gave the speech, and then when he had to kind of walk that back. But right before the end of the year, they the Fed put out an RFI, and which is the comment period that's closing, asking about this. And I saw this delightful headline in American Banker, which I didn't read it because of the paywall, but it was Fed's Waller. Everyone is yelling at me on skinny accounts. And so, Alex, I wanted to talk about how good the skinny account conversation is going and ask a little bit about your thoughts, both of us having kind of tertiarily watched this from afar for the last 90 days.
Yeah, it's been interesting. I mean, Kiah, you and I were talking about master accounts before it was cool.
Oh, yeah.
Way before it was cool.
I kind of regret, because now I feel like we walked ourselves to this story.
Well, we have to cover it, right? Even if we don't really want to. I mean, it's ironic on a bunch of different levels. I think the thing I keep coming back to fundamentally is, particularly in this administration, everyone seems to want to sort of show that they're doing something. There's a very performative nature to regulation under this current administration, right? And I don't know if we talked about on the podcast, but you and I at least have exchanged messages about the OCC's work on debanking, which is nothing, but it's sort of for the appearance of having done work on debanking, we will release this report that doesn't say anything. I kind of feel like this is the equivalent at the Fed in some senses, where it's hey, we want to show that we're leaning in. We want to show that we are taking payments innovation seriously. We want to show that we understand the concerns of companies that have not historically been able to get access to Fed master accounts, a lot of which are very kind of tightly aligned to this sort of tech crypto ecosystem that seems to be sort of dominant in regulatory circles these days. And so we're going to show them we're doing something by floating this idea of a skinny master account. And by the way, not just floating as a test balloon, but we're going to put out a call for comments, and we're going to take in comments from the industry and try to reconcile them. And what's been funny, and it kind of goes to the headline about the American Banker headline you referenced, is no one is that happy with this. And it's because fundamentally, and I wrote about this in my newsletter a while ago, the Fed is kind of boxed in as it relates to this issue, because they are not allowed to redefine what a bank is for the purposes of giving access to Fed services like master accounts. They don't have that legal authority, right? And so fundamentally, you have to be a bank in order to get access to Fed master accounts. So it's not as if all of these fintech companies that aren't banks and have no interest in becoming banks but would like to get master accounts, this isn't for them, right?
Yeah.
And it's not obviously for any existing banks that already have master accounts, because they want a full service master account with all of the bells and whistles that come with it, intraday, overdraft, and the ability to draw on sort of the Fed's kind of emergency liquidity tools. They want all of those other things that come with a full service master account. They don't just want access to the payment rails. And so it's very, I guess in a skinny sense, it's for a very skinny, narrow set of banks that are banks, but historically have been maybe being considered too risky, using that tier 1, tier 2, tier 3
the
sort of
institutions
framework
that don't
Fed
have deposit insurance, but do get to use the word bank because of whoever they got the charter from lets them use it.
Exactly. And you and I have talked about this before. There's a dozen of those, maybe. There's just not that many of those companies. And then the other thing that's interesting to me is, okay, so maybe it's still worth doing because for those dozen companies, they would really like it. Well, here's where Waller is getting yelled at again. The companies, the feedback they've given, the comments they've submitted have basically all said, look, a skinny master account doesn't do us that much good. And I'll use a very specific example, right? Stripe has sort of publicly commented on these master accounts, or folks who work at Stripe. And what they've said is they're look, we're Stripe. We're very big. We have a lot of scale. We can negotiate with partner banks, with correspondent banks that have access to master accounts, to get access to all of these services, including things like the ACH system, which we do want access to.
Yep.
And we can negotiate very favorable arrangements because of our scale, where not having direct access to it, it's annoying, and it creates some kind of like extra legal work for us and a little bit of like uncertainty risk in case one of our partners kind of cuts us off or whatever. But like fundamentally, like we have this already at a very good pricing and very good terms. So if you want us to convert to this other method and get a skinny account, and Stripe through its acquisition and Bridge is getting a national trust bank charter, and like they're starting to inch their way inside the regulatory perimeter. So in theory, they might be eligible to get a skinny master account, but they're saying like that wouldn't do us that good, and we probably would still rely on these correspondent banks to get access to the full suite of services. So again, who is this for?
Yeah, I also don't love the idea that the Fed governor is making everyone in the financial services ecosystem weigh in on whether a dozen companies should get something. But like also I can kind of understand that like we need some payment modernization infrastructure and licensure and probably account types, and that like the master account, I mean like the words, it's there, master, right? And so should we have like, kind of degrees? Should we have like the Cadillac of, accounts at the Fed, and then we have like, I don't know, the like Honda Fit at the Fed, I think there should be degrees.
That's what they're trying to do. I mean, that's so what the skinny account is.
It's so
like the Honda Civic of,
though. And so some of these companies, Stripe, have gotten very big without using the Fed. And so like, if the Fed's trying to get Stripe's business, then it should be different. But I can kind of applaud the Fed for trying.
Sure.
I don't know if what we need to do is, again, pass a law that puts out an MTL. That's an idea. And then there's just a lot more clarity around that. That's the
key thing, right? Is that it's the definition of a bank that qualifies. That's the thing. And the Fed just they don't have any say over that. Like they have to follow the law that was passed, and they are not a chartering entity, right? Like they don't decide who gets to be a bank in whatever various ways we define banks these days. And so like, this is either, I guess the way to think about it is either payments innovation, which is what Governor Waller is trying to solve for here. Either payments innovation is a problem for the OCC and other chartering entities to solve, and it's not really the Fed's job to do that, or Congress needs to update a very old law to sort of more flexibly define what is a bank and create more of these like, kind of gradations you were talking about. Because if you did that, I mean, I'm with you. Like, I think one of the sort of problems with the Fed, the way that it's sort of been built and evolved, is it tries to do too many things all as one big gigantic organization, right? Like I would actually like it and think it would work better if we had a separate regulatory or government entity that just ran our payments infrastructure and didn't do anything else. But I think that, the Fed really struggles with that because one part of the Fed will think, okay, we're just an unbiased operator of payments infrastructure, right? And I know some of the folks who work in that side of the Fed, and that's kind of how they think about it, is like our job is just to be neutral. We're not going to phase out checks, Kiah Haslett, because people are still writing checks. Our job is not to
I'm about to rant about checks so hard about related to this issue.
It's not to be judgmental about how people want to use it. Our job is just to provide all the infrastructure and be neutral and let people use it and have it be low cost and have it work really well. But then there are other parts of the Fed that are like, hey, we're sort of responsible for the safety and soundness of the financial system and transmitting monetary policy and these other things. And like maybe we
and
do
the lender
or don't
of last resorts, right? Like
and a lender of last resort, right? And so like because we're also those other things, we don't think that this entity should have access to Fed payment services because it would cause problems over here and over here and over here. And like I sometimes will bemoan the fact that we have this tension that exists between regulatory agencies where the CFPB wants open banking, but the OCC thinks it's not actually great because they don't really want more competition in the market. That tension can be problematic. Yeah, right now they want it. And the CFPB doesn't exist. But like generally speaking, I actually think that tension is really healthy, right? Like you kind of want regulators to fight with each other in order to most sort of like optimize for what their job is. And I think the Fed can't do that because it's fighting inside itself too much on some of these issues,
Well, I think one of I mean, back to payments innovation, which I think I can broadly agree with, and we can negotiate. One thing I'm like, hey, Waller,
Sure.
can we like figure out what the Fed should do about its check processing first? This is a bigger problem. The Fed processes half of the nation's checks, of which 11 billion were sent in 2021. So, you know, if we assume like a decline, maybe the Fed processed between 3 and 5 billion checks last year. And the Fed has come out and said, hey, we have done all the cost cutting we can, and our infrastructure, our technology that does this is at the end of its life. And we can't, and so we need to figure out, like, are we going to replace the tech and modernize it at great expense to everyone who still uses this technology? Are we going to not do anything and will you permit service degradations, including, like, I don't know, hold time increases and processing delays, or what? Like, and then can you just let us know? Because this is an issue that is urgent in a way that, like, again, the skinny master account, not urgent. We have actually, going back to that Stripe example, Stripe has figured out a way to live without this thing and doesn't seem to need it, or doesn't need it urgently the way that, like, I don't know, $5 billion of, like, or sorry, 5 billion pieces of paper need to be processed. And I just, like, I'm so, going back to that tension and the fighting, like, this is them fighting in its own payments division, right? Like, one thing at a time, please.
Well, and it's not even just like those two issues, because the other one I would throw in there is, like, we're still not super far along with FedNow, right? And, like, FedNow not that long ago was the thing that we're doing, and we're very excited about it, and we're putting all of our energy behind this. And,
Alex,
like,
I have a FedNow episode coming out soon.
Do you? Okay,
Yeah,
I'm glad.
next week.
I'm looking forward to hearing that, because I think that like, FedNow is a good example of one where, and you probably talked about this in your episode, like, most institutions still don't have send activated for
they call it receive
FedNow.
first, actually, is what they're trying to move away from send only, and they're calling it receive first.
Yes. And it makes sense from a business perspective, right? Like, if I'm a bank, I want money to come into me faster. I don't want it to go out of me faster. Like, I mean, referencing back to SVB, like,
Bold, yeah.
Speed is not great always. And so, like, I can understand it from the bank's perspective, but, like, if I was prioritizing for the Fed, I might try to, let's see if we can get as much of this network turned on and connected as possible before we start worrying about this other problem that's not even a problem. So I really do feel for the structure of the Fed in a lot of ways, because, again, like, I know the folks who are working in the payments part of the Federal Reserve, and they're just trying to, like, make shit work and make sure stuff doesn't break. Like, that is what they are trying to do. And then here comes Governor Waller, and he's like, hey, I have a new idea. And it's like, I mean, like, one of the groups that are probably yelling at him is the people working at the Fed, who are like, dude, what are you doing? Like, we don't have time for this.
It is really interesting, again, where the regulator chooses to spend its time, or this payment side of the regulator chooses to spend its time. And then, like, you know, the concerns about risk and how much, you know, like, how much innovation and risk do we need to allow into the regulated financial space at any given time? And also, like, what would actually be more useful to more people? Again, if we're having, as we are right now, having this whole conversation and everyone turned in those RFIs, so 12 companies could get some clarity about whether or not they get a slimmed down master account, like, that's not, that, like, that sends a message about where the priority should be,
well, and
where the regulators' priorities are, and then how we all have to think about where their priorities are.
Well, and again, like, who are those 12 companies? They're very big tech companies. They're very good payments companies. They're very big crypto or crypto adjacent companies. I mean, like, it does say a lot about who the constituency is that this administration and these regulators are trying to speak to and make happy. And, like, this, I think, is backfired because it's not even making them happy. But, like, the larger question of how you prioritize, I think, is also a very fair point of criticism.
Okay, let's stop talking about the regulators and let's talk about some banks for once.
So I can't believe that somehow on the outline, the ordering of it was structured in such a way where I'm the one explaining an accounting thing. Is that
you're the one who wrote about it most recently? So you those are the rules now. As the one who writes about fair accounting, fair value accounting, more recently has to talk about it.
I feel like you sent this to me, and then I stepped into the trap, and now this is the trap snapping shut. Okay, so yeah, I'll do my best.
My ploy worked, so
it did. It really did. So Kiah sends me a little note. I believe it was actually from Sam Haskell's newsletter, 5 Points, right, about Lending Club following in its competitor SoFi's footsteps. And again, for folks who are paying attention, SoFi and Lending Club are both fintech companies that started in lending and then acquired banks and are now banks.
Sometimes they're banks when it's useful to them. And sometimes they're not banks when it's useful to them.
That is exactly right. So what happened? Well, Lending Club reported its fourth quarter earnings recently, and the earnings surpassed analyst expectations and forecasted additional growth in 2026. However, due to a change in accounting methodology, there was a 14% drop in the company's stock price, which has kind of persisted since they announced their earnings. Lending Club stock continues to be down from where it was before.
Investor discipline, let's go.
Apparently. So here's what they did. They made a change to the way they account for loan losses. So I'm going to see if I can explain this without Kiah yelling at me. In very simple terms, there are two ways that you can account for potential losses with loans. One is reserve accounting, which is the traditional way that we do it in banking. When a bank makes a loan, it sets aside some money, usually around 1% to 2%, I think, of the loan, to cover losses that it expects to see over the life of the loan. So the downside, obviously, with that approach is that the new accounts, the growth that you just booked, looks worse on paper because you have to recognize those losses up front.
Yep.
The challenge, or I guess the benefit of it, and the reason why this approach works, is that it's conservative and it makes loan losses less likely to create volatility in bank earnings. It makes it sort of easier to assess risk because the risk is already essentially priced into the loan book, right? So reserve accounting, very conservative, very predictable, sort of irons out some of the inherent volatility in lending from an accounting perspective. That is the approach that Lending Club, and again, almost all banks in the universe, have taken to accounting for loan losses. SoFi, and you and I think I've talked about this in previous episodes.
We have talked about this on a previous episode.
Yeah, and this has gotten you into trouble with like SoFi Investing Bros, and it's like a whole thing in SoFi Stockland. They are one of a handful of banks, and then I suppose there are some other non-bank lenders that take this approach as well, that use fair value accounting. And in this approach, instead of assuming losses up front, the company estimates what a loan is worth at the moment that they book it based on expected cash flows and whatever pricing they think is fair in the market. And then depending on the circumstances, that estimate might be higher than the face value of the loan, might be a little bit lower, and so it can lead to, in some cases, premiums being realized on newly originated assets. The upside, obviously, is kind of the inverse of reserve accounting. You are able to recognize more value up front on the loans that you're adding. The downside is that the results are more sensitive to assumptions and market conditions, right? So bank profits quarter to quarter can be more volatile. It also makes it harder to compare, obviously, across lenders. So SoFi, I've always found very challenging to like assess.
It's really hard to understand their like from their investor presentation. I haven't looked at CapIQ, but where it might be a little bit more standardized, but it's very difficult.
It's very difficult. And now Lending Club is joining SoFi on the train of fair value accounting. Now, I guess, Kiah, I will say that I get two things as kind of I can understand where Lending Club is coming from.
Yeah.
One is that Lending Club, dating back to its P2P lending days, has operated a very robust like marketplace for secondary market investors to buy loans that are originated through Lending Club's platforms. And they have continued to very robustly maintain that marketplace, even as they become a bank and have their own balance sheet that they can keep loans on. And so the way I've thought about it in recent years is that marketplace that they offer and they run kind of acts as like an overflow valve for any loans that they don't want to keep on their books, or if they just have more demand coming through
interest rates. If interest rates are really low and you're able to make all these loans and people need yield.
Right. And so you can still generate revenue without having to be totally tied to how your balance sheet is looking at any one particular time. Obviously, that's not dissimilar to the way that a lot of other banks and lenders operate, where they will sort of strike a balance between those two. But Lending Club, because of just the maturity of their sort of capital markets infrastructure, they have done that very well and for a very long time. So one way of thinking about this is, hey, Lending Club already does fair value accounting for the loans that it sells to investors, because that's how that works, right? Like, you're just passing the loan over. It has to be valued in the moment that you are selling it. So a large part of their business is already fair value accounting. And one of the arguments they made is, look, we already do this. We have the discipline and the sort of underwriting approach that people can trust because we do this. So we should just have this fair value accounting method that we apply across our entire business, rather than having two different systems that we kind of use next to each other. The other, I think, more probably like likely explanation for why this is happening is Lending Club, I think, is just very tired of fighting against SoFi in particular with one hand tied behind its back, right? Like, it wants to have the ability to take the money that it should be able to get, the money it should be able to realize when it books new loans, and fully reinvest that back into growth, rather than to pay a price essentially for losses that may or may not happen. And so I think they look at it also as, SoFi does this, and then they reinvest their money in growing into this area or expanding into this area or making this acquisition. And like, we should be able to do more of that. And if the market's not going to punish SoFi, why should it punish us? But that then goes back to what you were saying, which is the market sort of seems to be punishing them, at least based on their stock price. So like, what do you think about those arguments? And what do you think this means about the future of your favorite area of the industry, which is bank accounting?
So again, I can't underline this enough. I was so confused by fair value accounting. The closest I normally play in this space is AOCI and the held to AFS, held to maturity treatment of securities.
Yeah.
I am just very used to banks holding most of their loans to maturity. And like, when all the other banks in the country do this, I'm like, whatever. Like, SoFi and Lending Club are surely not the first bank or institutions that have sold many of their loans.
No.
And like, you're acting like it's like, I don't know. It's like, then why did you want to be a bank? Like,
we wanted all the benefits and none of the drawbacks. Kiah has.
And I think, right. And I think that's, to me, like, I can both understand your argument, and I am not sympathetic to it, because you're not the first bank to run into this problem and complain about it. Like, all the banks hate CECL. Like, join the back of the line.
Yeah.
The other thing too is like the mark-to-market valuations is like really great for like gaming, and like to have like to not be like, the question is how accurate are their marks? And then also, do we have a sense at all about how either of these these loans they're making, the marks they're assigning, will perform in a financial crisis, right? Did you just incentivize yourself to not, reserve in advance for weakening credit the way like CECL makes you? Yeah. Because you're going to offload this risk. And then like, I don't know, as a reporter, I just assume to some extent they're trying to hide something, and or they're trying to make something look better, because it's not like reserve accounting doesn't work. Like, if it didn't work, no one else in the banking industry would do it. Yeah. And so I just don't know how, like, I would kind of hope over time these banks figure out how to make their models work with the reserve accounting. because I think they've got good models and I think they're interesting lenders and I want more institutions like them. I like super hate that like they might have done this over a stock valuation because as you know, I am like deeply uninterested in stock valuations, especially ones that I think are untethered from reality like SoFi. And so why would you want to be closer to this like fomented investor base that has like no, like I have talked to SoFi investors, like some of them in my DMs, and they were like talking about how like they were really hoping Galileo would be more adopted by more banks, but then they were like, yeah, I guess banks just don't change their core that often. And I had to be like, wait, what? Like you
were
thought
you surprised by
Galileo was gonna like swap out a bunch of core conversions in banks? Like that's
AWS
why
of fintech, baby. That was the strategy.
Like until they said that to me, I was like, dude, SoFi makes most of its money from interest income. Like you should get the best and most accurate information, and you're not, and I can tell you that you're not. And so like you just didn't understand something about banks. And so like why would you want why would you want this? And why would you want a higher valuation if you actually don't make that much kind of money because you're mostly still making it from interest income?
Yeah, I mean it's interesting, right? I mean I'm glad you mentioned that because it's a couple of things. One, I'm with you. Like I'm so deeply uninterested in stock price and like how that changes how companies behave, right? Like my general theory of the case has always been like if you just run a good disciplined company over a long period of time, investors will reward you for that, and you should just ignore.
Your tangible book value will go up.
Well, right, exactly, and it's like you build a durably valuable thing over a lot of time of just consistently doing the right thing, even when people aren't really watching. And what's interesting is I have always felt like Lending Club was exactly that kind of company, right? Like I would see the difference in stock price between SoFi and Lending Club, and I'd be like, I don't get it, because when I look at Lending Club, I see a disciplined business that knows exactly who it serves, and that every time it adds a new product or it expands in a way, it's a very thoughtful addition to this sort of like business it's trying to build. Whereas when I look at SoFi, what I've always seen is a company that just spazzes out and flies off in a million directions and buys Galileo and wants to be the AWS
Did
of
you know
fintech
that
and is
SoFi
launching its own stablecoin.
They moved their Mohila loans, Mohila student loan refis in-house?
I didn't know that.
My student loan was serviced by Mohila, and now it's serviced by SoFi. It is now back in-house.
Oh, weird.
And then I paid it off. But like, hey, remember the whole argument of fair value accounting is like they don't keep the loan or like I was like, so now it's back in. They moved the entire portfolio in.
Yeah, I mean, SoFi just like lurches around all over the place, and I don't think it's nearly as well run a business. I'm not going to say which one should have a higher stock price than the other, like that's not what I do, but fundamentally when I look at those businesses, I see one very disciplined one and one not, and it does kind of remind me of like, I don't know, like two people who are in college, and one person like goes to class every day, does what they're supposed to do, gets a lot of sleep, volunteers on the weekend, whatever, just like is very responsible and buttoned up, and makes the dean's list and gets all of these sort of honors. And then there's the person right next to them. Maybe they share a dorm room with this person, and this person does not go to class. They go to parties all the time. They stay up late. But you know what? For whatever reason, they're able to just roll out of bed, go to class, and just ace the tests. And they get the same grades.
Yeah.
And I feel like what happens a lot in business just generally is you have a strategy, and then the competitor right next to you, who's the most similar to you, also has a totally different strategy. And you just compete, and at some point you just get fed up with doing the right things and not being rewarded for it relative to the person who you think is doing the wrong things. And when I look at this decision fundamentally, it really feels like Lending Club, which had just been kind of just doing what it did and being really disciplined, looked at this and was just like, you know what? Fuck this. Like, we're going to do the same thing that these guys do. We're a more disciplined company.
Everyone else, and then it was like, actually, it's just this other guy.
It's just this, but I mean, I think they obsess over like, what the hell? Like, this doesn't make any sense. And I going back to your earlier point, I worry that is the thing that is going to lead to less discipline over time, right? Like at the moment, right now, And by the way, stock market analysts who study Lending Club closely, they've all said this, right? They're like, look, this is just accounting noise. It doesn't change the fundamental value of the company. They actually exceeded our earnings. They're on a great track for 2026. They're expanding into home improvement lending. Like, we like everything that they're doing. But if you are someone who invests in the stock market and you invest more at a category level rather than an individual company level, you know what a bank looks like.
Yeah.
And you know how to value banks. And Lending Club, by doing this, just took themselves out of you being able to easily understand and compare them against their peers. And so it does feel a lot like them over-rotating on just being pissed about SoFi and just not being able to take it anymore.
Yeah, well, let's stay tuned until the credit crisis comes, and then, or credit cracks, and we'll see how
see how disciplined everyone is.
Right,
actually.
and we'll see how their results are reported under fair value.
Yeah, we'll see. We'll see if there are any wild swings. And I know we said it was worth this, but I think it's actually worth this. I mean, that's why we have CECL, right? We learned this lesson the hard way, before, and that's why we do it this way.
Right. Well, can we continuing our, apparently throwback episode where we just talk about things that we've talked about in the past because there's no new news.
Yeah.
Can I talk a little bit about another charter type that we've seen recently?
I would very much like you to.
Okay. So, readers of my newsletter will know this, but I might as well rant. So we've talked about industrial loan charters before, ILCs, or industrial banks. And this is an old charter type. There are, due to regulations, only 6 states in the country that can now issue these charter types. Industrial loan companies are bank units that are owned by a non-bank parent company.
Yeah.
And so it can be a financial in nature, like Nelnet or Thrivent, or it can be, or like Optum, or it can be, and like Finwise, and there's Celtic. Like, I could just keep going on because we were in Utah recently, or it could be non-financial. And so there's some really well-known ones are the automakers and Pitney Bowes, the copy machine company. And, these are kind of controversial charters because they look like banks in a lot of ways, but, and they have a lot of the powers of a bank, but they have a different they have like certain carve outs, and that mainly that their holding company, their parent company doesn't have to be a bank holding company, and is not does not have Fed oversight.
Which is a big deal.
The big carve out, yeah.
Yeah, and just to pause on that for a second, bank holding company is like a designation that scares the ever-loving daylights out of a lot of companies that would otherwise love to have a bank.
And I think that's reasonable, right? It's a big deal. I was under the impression, again, if you think about becoming a reporter in 2011, I was under the impression that it is very hard to open a bank and run a bank. And then Erebor and these ILCs are kind of, sometimes waving that in my face a little bit. Anyway, and not all banks have bank holding companies. So there's that too, right? So this is its own thing. And so that's a brief history of ILCs. There have been 6 ILC applications that have been approved by their states. And then there are 6 the applications before the Deposit Insurance Board. And so last year, there were, the FDIC got so many of these applications that they were like, hey, pause, or it sounded like a pause. Can we just get an RFI out and how should we be evaluating these applications? And
so the FDIC is kind of getting, in some senses, veto power on ILCs. You can get an ILC from the state, but if you can't be insured by the FDIC, functionally, you can't really be a bank. Yeah,
you're not a bank. Well, you can be something else, but you can't be a bank.
Yeah. But as a bank wanting to do banking things, you kind of need FDIC insurance. Okay.
Right. Well, and if you want the real power of the ILC, because you can have a captive lender. Sure, you just can't take insured deposits, and so you don't get the cheaper funding.
Right.
And so so the FDIC was getting a lot of these applications for deposit insurance, asked and said like, hey, we should like just probably do like a quick pulse check with the public. What do we guys, what feedback do you guys have for us as we evaluate these applications? So
I
then
appreciate
everyone
them checking in. That was nice.
Right?
Yeah.
That's probably what you'd want to see.
Yeah, for sure.
Everyone turns in their comments, and then nothing except for 2 approved applications in January. And I was a little surprised. I actually started writing my piece before these applications were approved. And so when I did interviews, people they spoke as if the FDIC was going to issue guidance before it issued approvals. And I was like a little confused.
Which is not unreasonable.
Not unreasonable. And I would have just assumed orders of operation. That's probably how we're going to proceed here.
Sure.
That's not how we were going to proceed, the FDIC. I think it's like kind of a thumbing the nose. It wasn't, I wish there was kind of a statement that had come out that basically kind of explained why they felt comfortable issuing approvals before they issue anything, about the RFI. Because it's not even clear we're still going to get anything on the RFI. So stay tuned there.
Can I ask a clarifying question? Was the RFI issued under a different administration?
No.
And not... Okay, that was a question I had.
Yeah, I know that. I mean, the last administration just didn't do ILCs. So,
they just were no. They were just no.
They did not need any feedback about that.
That is pretty wild, though, that like under this administration, the FDIC would be like, yeah, we want to get some input on how this might work. And you're right. Like normally you ask for input, you formulate guidance or rules of some kind, and then based on that finalized guidance and rules, you start doing what you said we're going to do. Right.
Or yeah, just again, if you're gonna announce no changes, at least announce no changes. Don't do the RFI if you actually don't intend to. If you don't want the feedback, if you don't intend to use the feedback, it's that easy.
Totally.
Okay, so that's thing number 1 that kind of is like a little annoying about this, and then thing number 2 that I think is like we should interrogate like a little more, and I kind of can't believe like it's just basically you, me, and Jason who are like questions about this is. So there's 6 charters applications or 6 deposit insurance applications. And so the FDIC approves 2 of them. One of the 2 that they act on is the second filing of GM for a bank. And this is the same company that like 10 years ago, was it 10 years ago? 15 years ago. 15 years ago.
Yeah.
Like got into losses that were so bad at both the ILC level and then the parent company couldn't be a source of strength that they needed $17 billion in bailouts. And I will say, for all their fear about being a BHC, GM changed its ILC GM became a bank holding company because they weren't sure if they could like take the money or not. And so the easiest way to do it's the same like why Goldman changed and whatever. So for all their fear, they managed to get over it when they needed $17 billion in loans. And then like a series of things happens where like GMAC becomes Ally, it's spun off, GM's not a bank holding company anymore. And then, like, they
whoops,
still...
that's our bad. That didn't go great.
Our bad, guys. Like, whoa, we messed up. They have a captive finance company. Mm-hmm. So they're able to make loans.
Yep.
At wholesale prices, whatever. And, like, they refiled in 2020.
Okay. We
have an administration change. The application hangs out for 4 years. They withdraw the application. They refiled, like less than a year, like... in 25 sometime, and then it just got approved. And I'm like, I literally, like, again, I just need a statement from anyone to say, like, hey, I know what you're thinking. GM, again? And did you know that you can lose, in this country, you can apparently lose 17, like, you can have losses that are so great, you need $17 billion of literal bailout money, and in, like, 15 years, we'll give you another bite at that apple.
How infuriating would it be if you were like having this conversation with someone at the FDIC and they're like, well, but Kiah, they never failed.
Oh my God. Oh my God. That is also like, that is so not the like, why? Okay, I'm just realizing you said that so that I would emotionally respond, and it did work.
I'm triggering you, yeah.
But like, sorry, that's not like the bar here. The bar isn't like, did we close the bank?
It's were you a good bank?
Right. Oh man.
Which if you take $17 billion in bailout money, you're not a good bank.
You're not a good bank. Like also, and like, I just like, what are you gonna do, FDIC? What are you gonna do, State of Utah? What are you gonna do, GM, to make sure you never take another penny of bailout? Why are we letting GM apply for a bank again without making them be a bank holding company? Like, fine, you want a bank, be a bank holding company. You messed up so bad the first time, we will make a special like thing for you where you have like heightened scrutiny, and like, I can't. Again, when we think about the constituencies that the regulators are serving, and we think about who gets what, of all the ILCs, you could have approved another different separate ILC charter. Also, GM, of the two that were approved, Ford has to have more capital than GM. GM has to have half the amount of capital that Ford's bank will have. Like, can someone explain that to me? Like, what? Can someone explain it to me as if like it's not a giant conspiracy and it's not a handout and it's completely rational and fair, and I'm actually crazy for being like, hey, did I make up that 15 or 20 years ago we loaned this company $17 billion, and like that? I think that like that was the start of the punishments. Right? It was, you know what I mean?
I do. So everything you say, I agree with. It's wild. It's like, I feel like this has happened a lot in the last year or so. Year of the snake.
It wasn't a good year, Alex. I have notes.
No, well, I feel like one of the things I am constantly being sort of asked to do is just pretend to be stupid. Like, hey, here's some information. As you digest it, just pretend like you're stupid and it'll make sense. And
pretend
like,
you were born yesterday, yeah.
Right. Pretend you have no access to the internet or your own mind where you remember things from the past. And so like this fits into that category of like, hey, so what we're going to do is we're going to ask, because a lot of people seem to be interested in ILCs, we're going to ask for input on like, maybe how should we approach like, you know, deciding who gets one of these charters or not, who gets FDIC insurance associated with one of these charters. And then before we were even really done like reading all the responses we got from that RFI, we're just going to start approving ones that we get. And are we going to approve just random ones that we've never seen before? No, we're going to approve ones that have gotten us and taxpayers on the hook for problems that those companies have had. And it brings me to another question I had for you, Kiah, about ILCs, which is, I think ILCs overlap with this idea of embedded finance.
Okay.
And what I mean by that is this whole thing of like, it's a non-bank entity that wants to own a bank for some purpose, right? And I think fundamentally there are two ways to sort of square that, right? One is this non-bank entity that wants to be a bank is functionally a bank. It just doesn't want to comply with the requirements under the Bank Holding Company Act. And so like, I'll use an example. Square has an ILC.
That's correct.
They were one of the few that was able to get one when they were a little harder to get.
They got that magical Jelena McWilliams window.
Yeah. They hit the timing very, very precisely. Square doesn't want to be a bank holding company, but Square is a bank, right? Like Square is in every way, shape, a bank. It is a commercial lender. Yeah. It is now a consumer lender. It is a consumer bank. It is a consumer payments company. Like it is in every way, shape, or form a bank. And the ILC is just a little bit of regulatory arbitrage to be less annoying to Square and its investors. That's really like all that is happening there. To me, if I was, the bank trade associations, while I would be sort of annoyed by that, it doesn't really change any of the like risk profile of the overarching financial services industry.
Because it's a financial parent company.
Yeah. Well, yeah, and Square is going to make money or lose money by being good at being a bank, and their reputation is going to suffer or improve by how well they do as acting like a bank for small business owners and for consumers. So the incentives are roughly aligned for Square to be good as a bank, even though it is a ILC rather than a nationally chartered bank. Whatever. I think that's fine. The other version, though, is the version that scares me. And I think if I could give you a theory of the case, I think it's something to do with the idea of, look, we're not a bank. We don't make money on banking. We sell cars. We sell jet engines. We make copy machines. We fly airplanes around. We do whatever. And we have found a tangential area of our business that involves financial services. To use the car company as an example, we need to make loans in order to move the cars because people need loans to buy our product. Great. We have dealerships. We could do lending through those dealerships. Fantastic. Therefore, we would like to become a bank and have all of or most of the powers of a bank without being regulated like a bank and having to have a bank holding company and all that kind of stuff. I think, if I was to give advice to the FDIC, I think that's the profile that I would just be like, no, sorry. You can't. I'm sorry. like it's not the FDIC's job to litigate ILCs versus national bank charters. Like that's a different ball of wax for other people to argue about. It's the FDIC's job to look at the profile of these companies and go, why are you trying to become a bank? and the motivation behind you becoming a bank, is that going to lead you to do bad things that well-run banks would never do? And I think bad things that well-run banks would never do is very related to the purpose of why you're getting this thing, right? So if you are an auto manufacturer and you want to facilitate auto loans made to your customers so they can buy your car, guess what? There are bank partners out there. There's banking as a service. There's rent to bank. There's all of these models and infrastructure we've built to enable embedded finance without you actually becoming a bank.
Yeah.
You're welcome. We solved that problem for you. You're good to go. Just use that. You don't need to become a bank. The problem is, and this goes back to your GM example, GM goes, yeah, we know all that stuff exists.
We have a literal captive lender.
We have a captive auto lender. We know all that exists, but it would be more profitable for us if we had a bank, because then we could gather deposits and it'd be a cheaper form of lending. It'd be better, be vertically integrated. We would be happy. And regulators should look at that reasoning and go, okay, right. But if your motivation is clearly just to improve your unit economics, if it's just to make more money, if that's why you want to do this, then won't you be tempted to go do other risky things that we let banks do that might get you into trouble? Is it possible, perhaps GM, that you might decide mortgages are a great thing to get into, even though that has nothing to do with your business, that you might want to go do that? And we learned this lesson. We learned this lesson the hard way with GM and a bunch of these other ones that had trouble.
Yeah,
it doesn't seem unreasonable. GEG's another one where GE just went crazy and stopped doing GE things and started doing high risk finance things enabled by this charter. To me, it's very reasonable to say, look, if you want this, if the argument for you is more profitable embedded finance, no.
With insured money.
With insured money.
That's what they want, is the insured money.
That's exactly right. And it's if you want insured money to be more profitable at this little embedded finance thing you do on the side, no, because we don't like the risk profile of companies that do that.
It's not good enough for insurance.
Sorry for the companies that get dragged into that who didn't screw up, right? Sorry for Ford. Sorry for whoever. Sorry. You're all going to get kind of painted with this brush, but we don't like the risk profile. If you want to make money in financial services and be a financial services company, and this is just regulatory arbitrage between the states and the OCC and the Fed, fine. That's not our problem to solve. To me, that's a very rational way to sort goods from bads here.
Yeah.
I'm surprised the FDIC seems to have no interest in doing that.
I'm kind of okay with it because 100 years ago we decided we were okay with it. I do get it's codified in law. We have a long history of it. I do think it's interesting because obviously there's been more industrial banks in history. There's only 24 right now. It is interesting that GM and GE, I did not get into GE because they haven't applied for a bank or an ILC. So
maybe they have a sense of shame, perhaps. I don't know.
Well, GE realized one, that having its giant bank do crazy shit was causing risk for it, but then also realized that as a conglomerate, it was also having issues. And I do think it's really interesting because that we oh God, sorry. Tyler, you have to cut this out. I'm marking it right now. Shit, I had a thing to say about this.
It's interesting to me
sorry.
that... No, you're good.
Yeah, I'm just thinking it's about the type of companies that want to become banks.
Yeah.
So I think that I think there's a really interesting line between the financial parent companies and the non-financial parent companies that just want to have deposit insurance.
Yeah.
One of the things that I'm curious, I don't think it would happen, but would Walmart refile for an industrial loan charter? Because everyone's getting them. And
this was the big fight, right? Whatever it was 20 years ago. Yeah.
This united the industry.
They were over our dead body as Walmart getting an
right.
ILC.
And then, so since then, Walmart has acquired a fintech.
Yes.
And I also think that Walmart might still be a serious retailer or a retail force, but is I think Amazon is probably more of a boogeyman. And so part of me wonders if I was Walmart watching GM get its charter and then being like, how deep are the scars? And how powerful are community banks today? Because maybe the FDIC is not listening to them if they're approving these charters after the RFI.
Yeah, it's a great point, right? I think one macro theme from 2025 was just bank trade associations getting their asses handed to them from a lobbying perspective for the whole year by crypto, by big tech, by whomever, fintech. And I think they've managed to gain back some ground. I see that in the stablecoin debates. They seem to have figured some stuff out, and I think they are getting better at kind of navigating this new regulatory and lobbying environment. But I do wonder, almost reflexively, as some sort of is it coded in the DNA of community bankers to fear Walmart getting a bank charter so much that they would abandon any other fights they're fighting and go fight that one just reflexively? I think that's possible. I also wanted to ask you, Kiah, a bunch of other companies have applied for ILCs, right? And are in the process of trying to get them. Are there ones that you are more or less worried about? If you were trying to apply a risk framework to ILCs and trying to think about, what is some logical framework or system I could bring to evaluate the difference between these different applicants? Are there ones, setting aside GM, which is a funny case, are there other ones where you're versus this one makes sense? I
don't know if I'm worried about it. I think banks should be very worried about PayPal and Affirm applying. I think, the question is Affirm's business model resilient through credit cycles? But at the amount of consumer lending they're doing, sure, get some regulators in there.
Oh, totally. Yeah. Affirm reminds me kind of what we were saying before about Lending Club, where they've always been pretty buttoned up in the way they do stuff. Right. And so I feel reasonably good about Affirm. But to your point, from a bank perspective, I don't feel good about Affirm getting a bank charter. I don't feel good about Affirm integrating more deposit products and operating accounts and things and converting people to be full Affirm banking customers. To me, I think Cash App is a very instructive example about the competitive threat that ILCs pose. Because the Square ILC started as we do small business lending today. We just want to do it in a more sort of buttoned up way. It's just for Square. It's nothing. And now, Cash App is going really fast,
but it's just
really
small
hard.
Dollar loans, Alex. Isn't that so much? Isn't that fine?
They say it today, but then they're gonna, before you know it, they're gonna be using their Cash App score to do auto lending and mortgages and refi student loans and all kinds of stuff. So I think that is potentially very threatening. PayPal, I would worry less about just because PayPal can't get its shit together, which was a thing we had later on the agenda that we don't have time to get into. But suffice it to say, PayPal is one of those companies that just sort of like generationally like fumbles the bag just over and over and over again.
If PayPal could get its act together, it'd be a very serious contender.
Yes, it would be very scary.
Also,
and maybe that happens, but I'm not holding my breath.
One thing that I didn't have a lot of time to press on this, but one of the things that came up in my interviews is that for ILCs, there's like business plan, like because one reason why actually, if you have a financial parent company, you maybe are less worried is like, all of your incentives are aligned towards making money responsibly through financial channels. Yeah. But I'm kind of under the impression one reason why like GMAC might have been able, like GMAC gets its first ILC charter in 2004 and enters subprime lending in 2005.
That is insane.
I'm under the impression one reason why is because when you are the bank unit of an industrial company that is not a financial lender, that company can do might have many lines of business, right? So maybe it's
diversified. It's a conglomerate. Yeah.
It's a conglomerate, right? So like GM makes you a car loan, why not a home loan, right? And so that
said someone at GM. Yeah.
And so I'm not 100% sure, but like under, again, Erebor's de novo, they have a 3-year business plan. But when you're an ILC, I actually am under the impression it's a little bit easier to change your business plan, in part because of your parent company, which does add strength to your argument that non-financial parent companies should not be allowed to have ILCs because their business plans can change and you might not like the direction they point their bank in.
Well, and the other thing that they will do that I think is really dangerous is they will cross-subsidize their business as a conglomerate in ways that a financial services company can't.
And the ICBA do not like that they can underprice or underweight their risk in order to make a sale.
We really don't. But I
appreciate cheap car loans. Like, so my interests are... keep those car loans affordable. Like
no. What you want are credit unions.
Sell it to me.
You're asking for more credit unions. That's what you're asking. You're not asking for ILCs from companies that have taken bailouts before. You're asking for credit unions. I mean, I think that, on a serious note, I really do think that the one of the challenges with the cross-subsidization perspective is it does allow you, if you want, or if you're in a moment where your company sort of is acting this way, to lose discipline on what you're doing, right?
Sure.
And so it just allows you to say, I mean, again, I don't know the history of GM, so I'll just speculate here, but like with GM in 2005, they were probably having a bad quarter somewhere else, right? Like it was probably like, this is a bad thing over here. Hey, does anyone have any brilliant ideas for how we can make a bunch of money? There's a ton of yield over here. And when do house prices go down? This is great. Like you can see the logic string together of, in a boardroom filled with people who don't know banking, they would look at banking as just one more asset that they can move around to make the math work and make shareholders happy next quarter. That is very, very dangerous and is a significantly different risk profile than a financial services company like in a firm or a PayPal or whatever, where you can be assured that a reasonable number of people sitting in those board meetings understand banking, understand financial services, understand the unit economics of finance, and the fact that the yield that you're looking for over there, that's only available because it's incredibly high risk, and that is bad for our business and our reputation if we go chase it. I don't have the same confidence that all companies think that way or have that capacity.
Yeah. Not to keep hammering GM, but by 2008, again, they get their charter in 2004, more than 75% of their loan issuances were real estate loans. That's how fast it happened. That's what we just gave them a charter. Isn't that crazy?
It is.
Can you believe it, Alex?
I really can't. I'm glad that you're not letting this go and ranting about this because I'm with you now. Like I will join you on the ranting train.
I think you're a little further than me because I still want the cheap car loans. I think we could strike the middle ground, but not on this one. So
no. Well, and there should be like a penalty box, right? Like if you are if you raise your hand, if anyone has taken billions of dollars in bailouts within the last 30 years, just go away and don't apply for this. And
don't apply for it. Yeah.
I at least give GE credit for like, hey guys, that was our bad. Like we're not going to come back and ask for this again. Like just serve your sentence, man.
Yeah. All right. Well, thanks so much for chatting with me about all of these topics that we have previously talked about before. It's good that nothing's new anymore because I don't know if I could handle truly new pieces of information.
Well, anytime we try, we end up talking about like tokenized deposits and just like losing the plot entirely. This was very fun, and I'm sure we'll have many new and old things to talk about next time.
All right. And if anyone has merch ideas, let us know.
Hit us up.
Thank you for listening to this episode of Bank Nerd Corner. Stay up to date with news and trends in the bank space by subscribing wherever you get your podcasts. Also, if you love FinTech Takes Banking, please tell a friend. Talk to you next time.